Have you noticed rising prices at the grocery store or heard about businesses closing? These are signs of a potential economic downturn. Are we heading into a recession? But what exactly is a recession, and why does it impact our lives so much? There's a saying, hard times create strong men create good times create weak men, and weak men create hard times. We might be at the bottom of this cycle, facing hard times that test our resilience. In today's video, we're going to delve into the mysterious world of recessions. We'll uncover what a recession truly is and why it has such a profound impact on our daily lives. We'll also explore related concepts like inflation and deflation and discuss how a recession feels both economically and personally. Whether you're worried about your financial future or just curious about the economy, stick around. By the end of this video, you'll understand recessions better and why they matter. All right, let's talk about recessions. You've probably heard the term a lot, but what does it really mean? A recession is when the economy slows down for a while. Technically, it's when there are 2 straight quarters, or 6 months, of negative GDP growth. But what's GDP? GDP, or gross domestic product, is the total value of all goods and services produced in a country over a specific period. It's a key indicator of economic health. When GDP declines, it signals that the economy is shrinking. Think of the economy as a large, complex machine. When it's running smoothly, businesses thrive, jobs are plentiful, and consumers spend money, fueling further growth. However, when this machine starts to falter, economic activity slows down, leading to a recession. During a recession, several key indicators signal trouble: a drop in GDP, rising unemployment rates, decreased consumer spending, and a slowdown in industrial production. Together, these factors create a ripple effect that impacts nearly every aspect of the economy. Historically, recessions have been part of the natural economic cycle. They occur after periods of economic expansion and can be triggered by financial crises, significant disruptions in supply and demand, or external shocks like natural disasters or geopolitical events. So, what does living through a recession actually feel like? Well, it's not fun, that's for sure. First off, the economy takes a hit. Businesses start struggling because people aren't spending as much. This leads to layoffs and higher unemployment rates. You might hear about big companies downsizing or even going out of business altogether. For individuals, this can be really tough. Losing a job means less money to cover bills, rent, or mortgage payments. Even if you keep your job, you might find that prices are higher for everyday items like groceries and gas, making it harder to make ends meet. Communities also feel the strain. When people have less money to spend, local businesses suffer, leading to more closures and fewer services. This can create a sense of uncertainty and anxiety as people worry about their financial future. On a larger scale, the stock market often takes a dive during a recession. Investments lose value, which can hurt retirement savings and lead to a general sense of financial insecurity. But it's not just about the numbers. The emotional toll can be significant. Stress levels go up, and people may feel a sense of hopelessness or frustration as they try to navigate these tough times. So, what actually causes a recession? There are several factors, and sometimes it's a mix of things. One big cause is financial crises. Think of the 2008 global financial crisis when banks and financial institutions took huge losses due to risky lending. When these institutions fail, it creates a ripple effect that impacts the entire economy. Another cause is high inflation. When prices rise too quickly, people can't afford to buy as much. This leads to lower demand for goods and services, causing businesses to cut back and lay off workers, which slows the economy down even more. On the flip side, deflation can also lead to a recession. When prices drop, people might wait to buy things, expecting even lower prices. This reduced spending makes businesses cut back, leading to job losses and economic decline. External shocks like natural disasters or political instability can also trigger recessions. A major hurricane can disrupt supply chains and damage infrastructure, while political issues can create uncertainty and reduce investment. Lastly, structural changes in the economy, like new technologies or shifts in consumer behavior, can also play a role. These changes might make some industries obsolete, leading to job losses and economic adjustments. So, How do we control and mitigate recessions? Governments and central banks play a big role here. First, let's talk about fiscal policy. This is when the government adjusts its spending and taxes to influence the economy. During a recession, the government might increase spending on things like infrastructure projects to create jobs and boost economic activity. They might also cut taxes, giving people more money to spend and stimulate the economy. Next, we have monetary policy, which is managed by central banks like the Federal Reserve in the US. Central banks can adjust interest rates to influence borrowing and spending. Lowering interest rates makes loans cheaper, encouraging businesses and consumers to borrow and spend more, which can help lift the economy out of a recession. Central banks can also inject money into the economy through processes like quantitative easing, which increases the money supply and encourages lending and investment. In addition to these policies, other measures like unemployment benefits and social safety nets can help cushion the blow for individuals and families during tough times. Managing a recession isn't easy, and it often requires a combination of strategies to stabilize the economy and promote recovery. So, what's the domino effect in a recession? It's when economic troubles in one area start to spread, like falling dominoes, and impact other parts of the economy. Imagine a big company facing hard times and laying off workers. Those workers now have less money to spend, so they cut back on things like eating out or shopping. The restaurants and stores they used to visit see fewer customers and might have to lay off employees or even close down. This creates a chain reaction of job losses and reduced spending. On a larger scale, if a major bank fails, it can lead to a credit crunch, where businesses and individuals find it harder to get loans. Without loans, businesses can't expand or even maintain operations, leading to more layoffs and an economic slowdown. Recessions can also spread globally. If a big economy like the US goes into recession, it can reduce its imports from other countries. Those countries then face their own economic slowdowns due to reduced demand for their products. The domino effect shows how interconnected our economies are and how problems in one area can quickly spread and become bigger issues. So, how can we prepare for future recessions? While we can't always predict when a recession will happen, we can take steps to be better prepared. First, build an emergency fund. Savings that cover 3 to 6 months of living expenses can provide a financial cushion during tough times. Start saving now, even if it's just a small amount each month. Diversify your income. This might mean having a side gig or investments that generate extra money. If one source of income dries up, you'll have others to fall back on. Stay informed. Keep an eye on economic indicators and news. Understanding the signs of a potential recession can help you make better financial decisions. For businesses, manage debt wisely and have a plan for maintaining cash flow during downturns. This might involve cutting non-essential expenses or finding new revenue streams. Lastly, focus on continuous learning and skill development. Being adaptable and having a versatile skill set makes it easier to find new job opportunities if your current job is affected by a recession. By taking these steps, we can better navigate the challenges of future recessions and come out stronger. Thank you for watching. If you found this video helpful, please like, subscribe, and hit the notification bell to stay updated with more content. Stay tuned.